Have you ever wondered what would happen if a country simply printed an unlimited amount of money? Sounds like an easy solution to financial problems, right? After all, if you need more cash, why not just print more? But this idea is far more complicated than it seems, and the consequences of printing too much money are devastating. In today's video, we'll dive deep into the economics of money printing and explore why this seemingly simple solution can lead to disastrous consequences. So, grab a seat and get ready to learn about one of the most critical concepts in economics: hyperinflation, devaluation, and the collapse of economies. The basic concept of money printing. At its core, money printing is the process by which a government or central bank issues new currency into circulation. This can be done either physically, by printing new banknotes, or digitally, by increasing the amount of money in a country's banking system. Governments often resort to printing money when they face financial crises or need to stimulate economic growth. However, the process isn't as straightforward as simply creating more currency. The relationship between money supply and inflation. One of the primary risks of printing too much money is inflation. Inflation happens when the general prices of goods and services rise, eroding the purchasing power of money. It occurs when there's too much money in circulation relative to the amount of goods and services available. In simple terms, imagine you have a small town where only a few apples are available for sale, but everyone in town has extra money. With more money chasing fewer apples, the prices of apples will rise. The more money the government prints, the more money there is in circulation, and thus, the more the prices will increase. This is demand pull inflation. However, inflation doesn't stop there. It can spiral out of control if left unchecked, leading to a phenomenon called hyperinflation. Hyperinflation, when inflation goes beyond control. Hyperinflation is a situation in which prices increase so rapidly that the currency becomes almost worthless. Think of it as an explosive form of inflation where prices can double in days or even hours. Countries that experience hyperinflation usually print money excessively to fund deficits or manage debts, but the economy is often unable to keep up with the influx of money. One of the most infamous examples of hyperinflation occurred in Germany in the 1920s. After World War I, the country faced enormous reparations and a collapsed economy. The government began printing money to pay off its debts, and as a result, the value of the German mark plummeted. People were forced to carry wheelbarrows full of paper money just to buy basic items like bread. In the worst-case scenario, prices would increase so fast that a loaf of bread would cost more by the time you finished reading this sentence. Another more recent example occurred in Zimbabwe in the late 2000s. The Zimbabwean government printed an immense amount of money to cover its growing debt, and as a result, inflation skyrocketed. At its peak, inflation was estimated at over 89.7 billion% a month. People would trade in piles of banknotes to buy a loaf of bread, and the currency became essentially useless. The government had to abandon its currency and adopt foreign currencies like the US dollar. The impact of excessive money printing on the economy. When a government prints too much money, it not only leads to inflation and hyperinflation, but it can also cause a collapse of the economy. In the case of hyperinflation, the value of the currency diminishes so quickly that people lose faith in it. Individuals may start to hoard foreign currency, or resort to bartering goods and services as a form of exchange. This breakdown in the use of the national currency can lead to a loss of confidence in the economy as a whole. Investments shrink, businesses close, and unemployment rises. A country's credit rating drops, making it difficult to borrow money from other nations. Excessive money printing can also lead to a rise in debt. Governments often print money as a solution to cover budget deficits. But printing money without a solid economic foundation is just a temporary fix. Eventually, the country's debt obligations increase because the money becomes worth less and less. This leads to a vicious cycle of borrowing, printing, and rising debt. Currency devaluation and the loss of trust. One of the most dangerous consequences of printing too much money is currency devaluation. Currency devaluation occurs when a country's currency loses value relative to other currencies. This can happen when the government floods the market with too much of its own money. As the supply increases, the value drops, and international investors begin to lose trust in the currency. When this happens, the exchange rate between the devalued currency and other stronger currencies, such as the US dollar or the euro, becomes unfavorable. Import prices rise, making goods and services more expensive, and inflation accelerates. This can make imports unaffordable, leading to shortages of essential goods like food, medicine, and fuel. The psychological impact, a loss of confidence. Hyperinflation isn't just about numbers, it's also about psychology. People in countries experiencing hyperinflation often begin to lose confidence in their currency and government. This loss of confidence can spread throughout society, causing panic and social unrest. People may start exchanging money for tangible goods, hoarding food, or withdrawing all their savings from banks. This behavior can cause even further instability in the economy. In some cases, governments will attempt to fight hyperinflation by introducing a new currency or pegging their currency to a stronger foreign currency. However, this process can be slow, and even with reforms, it can take years for the economy to recover fully. Can a country avoid the dangers of printing too much money? While printing money is often seen as an easy solution, the reality is far more complex. Countries need to balance the supply of money with the real needs of the economy. Governments and central banks use various monetary policies to control inflation, manage interest rates, and stabilize the economy. For instance, central banks like the Federal Reserve in the United States or the European Central Bank monitor inflation rates and adjust policies to avoid an economic crisis. They use tools like interest rates, reserve requirements, and open market operations to regulate the money supply without triggering inflation. But there's a fine line. Printing money can be a useful tool for short-term economic stimulation, especially during recessions. However, if it is done excessively or without consideration of the economy's long-term health, it can lead to devastating consequences like hyperinflation, devaluation, and economic collapse. Conclusion: the true cost of excessive money printing. What happens when a country prints too much money? The consequences are clear: rising inflation, the devaluation of the currency, economic instability, and, in extreme cases, hyperinflation. The solution to a struggling economy is not always as simple as creating more money. The real challenge lies in creating a balanced, sustainable economy that fosters trust, growth, and financial stability. And remember, while printing money might seem like an easy fix, it's always best to focus on building a strong, healthy economy that doesn't rely on short-term solutions. Thank you for watching, and don't forget to like and subscribe for more educational content on economics and finance.